Presidential election and the stock market have an interesting relationship. The S&P 500 is continuing to skyrocket every day here in 2024, and it's up like crazy already. QQQM is the growth ETF, and it's up even more with companies like nvidia, Tesla, Microsoft, and Apple leading the charge. Many analysts expected a recession this year, or at least very little to no growth based on high inflation and high Fed rates, but we are still booming. This is very suspect, and as I'm sure you're aware, this year is an election year. Is the stock market propped up artificially for a political agenda? Tough to know, but looking at the data, usually during a presidential election year, the stock market is mostly steady or positive, which makes sense for voters to have confidence in America, but the year after is when the rubber meets the road. One big thing to keep in mind is the CPI data and inflation data each month. For last month in June, we just received word that it was actually quite good.
Well, futures, as we've been continuing to track them this morning, they are higher after that June CPI data came in cooler than expected, declining actually 0.1% month over month. A rise of 0.1% was expected. Joining us now, we've got Tom Porcelli, who is the chief U.S. economist at PGIM Fixed Income, and Greg Dacko, who is the EY chief economist. Great to have you both here with us. Just want to get your read in. I mean, we were expecting a fractional gain on the all items essentially, but we got a fractional decline here. And so, I mean, are we on the train to deflation, or is it too early to declare victory at this juncture? Tom, I'll go to you first.
Yeah, so good to be with you all. Yeah, look, I think that we are on the train to the Fed teeing up a cut. Look, I think we were on that train before this number. But I think this number gives the Fed quite a bit of comfort. If you look at sort of some of the components, yeah, I get it, right? You know, in so many ways, the shelter component is putting a floor underneath in inflation at large, and it behaved very sort of nicely this month. The thing that the Fed, one of the key reasons why the Fed even created this super core measure was to basically, in part, to remove the shelter component, because I think everyone sort of appreciates that it's just, there's some calculation issues there. So if you just look at headline CPI and you look at core CPI and you strip out shelter from both of those, you're now under 2%. You're running at a 1.8% pace. So I think the inflation fear that had been out there for so long, I think that, the Fed is now, I think, moving beyond that. And I think the Fed is now really focused more on labor, which I would argue that they've actually been more focused on that for months. But I think, Powell is now really sort of driving that home more out in the open. So I think with labor starting the process of slowing down, I think it's very reasonable to expect that the Fed will start the process of removing some of those hikes that they put in place.
So basically he was saying that inflation has been cooling, which is a great sign, but that the Fed rate cuts have more to do with just inflation. What I thought was very interesting is this next part, and they go deeper into the actual presidential election and what that may mean for Fed rate cuts in the future.
Greg, do you think July's on the table?
July is on the table. I think it should have been on the table. I think June should have been on the table as well as an optimal time to recalibrate monetary policy. I think there's been way too much attention being given to this first rate cut. What we're talking about is really recalibrating monetary policy to today's circumstances and tomorrow's outlook. I think Powell was clear in his testimony to Congress, saying that inflation is no longer the main risk and the only risk that we face. We are in an environment where you and I have discussed this in the past, where inflation has been cooling. The underlying drivers of disinflation remain firmly in place. We have slower consumer spending. We have weakening labor markets. We have an environment where pricing power has diminished and where pricing sensitivity has increased. These are all disinflationary. So these types of reports that we just saw this morning, where inflation continues to ease, is exactly the type of report that the Fed is looking for as we continue to move closer to the Fed's 2% target. I think now is really the time to reconsider whether we need as restrictive monetary policy as we've had for the past year, or whether it's time to gradually recalibrate and avoid exerting too much pain on the economy at this delicate juncture.
I mean, this delicate juncture as well, just to follow up on that, Greg, is really because we have a general election as well in November that places them in the scenario of, okay, if we're going to seem apolitical, do we have to get out ahead of that with enough time to be able to cut, or wait until the dust is settled and then initiate that first cut? I mean, what is the calculus you imagine that the Fed is navigating through, especially as they do run the risk of remaining too tight for too long because of that central event that the political sphere is paying close attention to in the markets to a certain extent?
Definitely an optics element to the Fed's decision when it comes to the elections, but I think the Fed is really keenly focused on ensuring that inflation moves down in a sustainable manner towards its 2% target. There are a few policymakers that are still leaning towards the hawkish side, are not likely to be in favor of any imminent rate cut. But I think gradually we're going to see Fed Chair Powell lead a core of Fed policymakers towards adopting a softer monetary policy stance, a less restrictive monetary policy stance, and recalibrate. The numbers in this report were very interesting because we have one of the key elements that has been supporting inflation, as Tom was saying earlier, which has been shelter cost inflation, which is now moderating quite significantly. And at the same time, you're seeing pockets of softness on the services sector side. Hotel prices falling 2.5%, airfares falling 5%. These are signs of consumers exercising more prudence and businesses having to adjust their pricing in this more prudent consumer spending environment. I think the Fed should take note of this increased consumer prudence and recalibrate monetary policy, again, to today's economic realities.
A couple of huge things for us to consider here. Number one, he said July is on the table. That would be much earlier than expected, and if they announce a rate cut, in my opinion, I feel like the stock market is gonna jump based off of that really good news. Number two, the second thing to consider here is about what's been happening. People have been spending less. Companies have brought prices down in some arenas, making profits lower. And with all of this, the stock market has still been rising steadily when it should have been causing a bit of a dip in the market. Number three, and one of the biggest pieces here, is what they said about the presidential election and how that might affect the rate cuts. There may be some politics involved in when the Fed will cut rates surrounding the election. We may be ready for a lighter monetary policy based on facts and data, but the government may not issue a rate cut until after the election for their benefit. All of this to say that we have absolutely no idea what actually could happen, but we definitely need to prepare for it. In my opinion, the stock market should be dropping right now, and it isn't. When the Fed does issue a rate cut, I believe the stock market will go much higher because this signals that our economy is doing much better and that we're ready for another bull market. So I guess if they do make a rate cut before the election, we'll just see what's actually going to happen within the market. Since we're slated to have many rate cuts over 2025 and 2026, which is after the election, I don't believe that the stock market is going to crash. Depending who gets elected, we may see some emotion in the market and it'll be a volatile market for a couple months. But overall, I believe that it's going to be very steady. There will be some spikes, there will be some dips, but the fact that inflation is cooling is only a good sign. To see what I'm investing in and when I'm investing, go ahead and watch this video now, or watch this one to keep you going strong in your investing journey.